Good afternoon, everyone, and welcome to this special webcast. My name is Joshua Van Gestel. I'm the Senior Manager of Education Delivery at Australian Retirement Trust, and I'm joined this afternoon by the man of the moment, Brian Parker. How are you, Brian?
Very well, Josh. Good to be here.
Thank you for coming. Now, Brian and I, over the last few months, have been going around the country. We've spoken to
A lot of people.
Yeah, it's been wonderful, actually. But in that time, we have seen markets be quite volatile. Brian, without stealing your thunder, have there been some themes that have come through that you're actually going to reflect on this afternoon?
Well, there's one thing you can say about President Trump. He's very, very good for seminar attendance. So we're certainly getting a lot of questions about market volatility, a lot of questions about Trump and about tariffs, etc. So certainly you've seen a lot of people both interested and worried, if you like, about where the world might be heading and where their super might be heading.
And would it be fair to say that what we're wanting to do today is actually talk to people around how they should be thinking about all this volatility and changes that have been happening in markets, but to perhaps think about the long-term view as well?
Yeah, very much so, because I think if there's one thing to take out of today's session, it's a reminder that superannuation is really the longest term investment any of us are ever going to have. And when you think about super as a long-term investment, it changes the way you view market volatility right now. And so
wonderful.
That's what we're aiming to talk about.
Well, strap yourselves in, and we will, over the next hour, actually run through a presentation that Brian's going to provide. But we're also, at the end of that presentation, going to allow time for Q&A. Now, we are expecting that we're going to have thousands of people in the event today. So any questions you post won't individually be responded to, but we do have our team on hand who are looking at the questions coming in, and will be feeding to me the common themes or really pertinent questions for the audience that I will put to Brian. What I'd like to do, though, before we start is actually make three acknowledgements. The first is to all of you for your time, your interest, and your own investment of time in your investments within your super. The second acknowledgement I'd like to make is to the traditional owners of the lands on which we're broadcasting from today, this place now called Brisbane, which has the traditional owners of the Turrbal and Yuggera people. I'd like to also, though, acknowledge the Gadigal and the Darug people where Brian and I reside in Sydney, and also any First Nations people who are joining us today. The important thing to note throughout today's presentation is anything that I go through, as well as anything that Brian talks about, plus questions that we respond to in Q&A, please note that that information is of a general nature only. We don't know your personal needs, circumstances or situation, but encourage you to reach out to us or speak to your own financial advisor if you have one, if there's anything that we raise that is of relevance to your personal circumstances. Now, with Australian Retirement Trust, we are one of the largest superannuation funds in Australia and one of the largest retirement funds globally. And this means that we have a very large responsibility for you as one of our 2.5 million members. On your behalf, we've been entrusted with over $300 billion of your money, which we're safeguarding through to and well into your retirement. So investment performance is a crucial focus for us and is a very important area for us to be discussing. And that's why we've got Brian here with us today. Now, as I said at the outset, Brian and I have actually been travelling around the country and speaking to a whole range of members, and it's been wonderful in not just having us do those presentations, but we have had queues of people wanting to come and speak to us at the end of those seminars. Some of them, the very few, have even complimented Brian on some of his jokes, which we might get to share with you today. But there have been three really common themes that have been coming out of those discussions. Obviously, there is concern. There is worry about the economy, about what we're seeing happen globally, and whether that actually has any concerns on people's investments in their super and their performance. We're also seeing a lot of people concerned, especially as they approach retirement, worried about what might be happening with their balance and perhaps not realising that there is still great opportunity for them with their investments well into their retirement. And that's something that we'll cover off today as well. And the third question, and perhaps it seems like an obvious one, is, well, what can I be doing or what should I be thinking about? And this is also something that we're going to address with you today. So please, as I said, we do have Q&A open. We do have moderators who are looking at the questions coming through. And although we won't be responding to those questions individually, they will be feeding through to me any common themes or areas for us to discuss. So I suggest that while Brian's speaking especially, note down any questions. And if we don't respond to those throughout Brian's presentation, do submit those through. You also have the ability to work with us or to reach out to your own financial advisor if you have one. So if at the end of this presentation there are real areas of concern for you, there's real action that you want to take, then certainly we encourage you to reach out. But the thing that we're hoping you also walk away with today, though, is confidence and understanding and a bit of awareness about how we're actually managing the current times and what we're doing with your investments. Certainly with that long-term view Brian's already responded to. Now, before I do hand over to Brian, I just want to set up a couple of things that Brian's actually already spoken to, but that will be very pertinent to the content that he's delivering. Firstly, as we've all been experiencing over the last few months especially, our superannuation is market exposed. And although that comes with risks that we have seen with volatility, it also brings about opportunity. And I'm actually going to make sure that I ask Brian about some of those opportunities that we're taking and that he sees for our members in Q&A. Remember too, and something we're very much going to focus on, and Brian has already made mention of, is that your super is perhaps one of the longest term investments you'll ever have. So when it comes to managing your superannuation, we're not really looking at what's happened in the last week, the last month, or even the last 12 months. Although we're cognizant of them, although we are taking some actions where needed, we're very much focused on what are we delivering for you in the long term, 10 years or more, including for those of you who might already be well into retirement. And thirdly, remember as we go through that you do have choice. You have an incredible investment menu available to you at Australian Retirement Trust, and you have great choice in that menu should you feel that you need to check in on your investments or make a change. And we'll actually talk about that towards the end. Now, three key themes that you'll also see coming through in Brian's presentation and what I wrap up with at the end is that the way you need to think about your investments in your super is, well, firstly, what is your time frame? Are you like Brian and I, who are in our 50s and really have about not just 10 or 15 years of work ahead of us, but 20 or 30 years of real investment opportunity as we enter well into our retirement? Your investment journey doesn't end at retirement, it continues right through. So think about that time frame in context of what we're speaking about today. Also, though, we'll be talking about your risk tolerance. How comfortable have you been with the volatility? With some of the members we've been talking to as we've travelled Australia, we've actually had some of those members talk to us about how they're taking the opportunity at the moment to add more into their superannuation. And this is something that we'll come to in Q&A. But the third thing is really balancing out that time frame and your risk tolerance to what level of returns or expectations you have. And I'll come to this in a moment, but usually you see hand in hand that risk and volatility actually give a higher long-term return expectation. And this is something Brian will certainly come to. Fourthly and finally though, when it comes to your investments, you have to think about how much control or involvement with those investments do you want? Do you want us to look after it for you? Do you want to be making some choices along the way? This all again is something that we'll cover off. Now in Brian's presentation, he's going to be talking about a number of different asset classes. And I know many of you will know these asset classes well. But the main things that you'll see discussed are what we see as traditional growth assets. Things like shares, both here in Australia as well as internationally. Shares provide incredible growth opportunity with super, but as we're experiencing now, they do come with volatility. So superannuation funds like Australian Retirement Trust have also diversified some of your investments into cash and fixed interest assets. But the reality with these assets, as Brian will show, is that in recent years, certainly since COVID, they haven't been providing the strong returns that our members demand and expect for their superannuation. Australian Retirement Trust, as one of the largest superannuation funds in Australia and largest pension funds globally, that brings opportunity for us to look outside of these traditional markets at things that are alternative to this. Property, infrastructure, private equity, all of which Brian will come to. So in thinking about all of these, it's important to understand that they all come with different risk, they all come with different return objectives, but they all provide diversification and opportunity for the way we invest your money. Finally, before I pass to Brian, it's important to know that these assets that I've gone through, the way they look on your account will be very much based on how you're invested and the choices you've made. As you can see, with high growth on the far end of the screen, very high exposure to equities, as well as those alternative investments. And as we move across the screen to conservative balance, you can see that those growth exposures are actually reduced, and there's a higher exposure to those traditional assets like cash and fixed income. So I hope this is all set up for what Brian's going to cover off. And with saying that, Brian, I will pass over to you, sir.
Thank you very much, Josh. And again, thank you very much, everybody, for dialing in today. This is perhaps going to end up being one of the biggest webinars, if not the biggest webinar that we've ever done at ART. So thank you very much for showing an interest. Let me quickly address what's been happening in the last few months. So what I've done here on this chart is just to illustrate the performance of share markets, both here in Australia and internationally, but also the performance of bonds or fixed income assets. So this is what's happened if I put $1,000 into each of these ART investment options. So the bonds index option, the Australian shares index option, and the international shares options. What's happened with my $1,000 since the end of December 2024? These returns are also net of fees and net of superannuation tax and net of investment costs. They're also passive investment options. So we're not trying to add additional value through superior investment performance. We're simply building portfolios that replicate what the underlying markets are actually doing. Now, my $1,000 started off looking pretty good. That certainly share markets around the world started the year on a pretty positive tone, but as trade tensions continue to pick up and culminating in President Trump's Liberation Day, where he announced widespread tariffs on pretty much every country on the planet, that was greeted very, very savagely by financial markets. And so you saw very sharp falls in equity markets, both here in Australia and internationally. But what's also interesting on this chart is just how quickly things rebounded. And since this chart finished off on the 23rd of April, we've actually seen further gains in share markets. That's not to say we're 100% out of the woods yet, but it does show you just how quickly markets can turn. And trying to predict these kind of developments in the short term is next to impossible. It's a theme I'm going to return to over the course of this presentation. But I also think it's worth putting these returns into some longer term perspective. So what I've done in this chart is to basically show you the performance of the major asset classes we invest in over the last decade, or at least the decade leading up to the end of December 2024. And there's a few observations I want to make on this chart. Firstly, the last decade was actually a very good time to be an investor. Generally speaking, if you invested in higher risk assets, the growth assets that Josh talked about, particularly Australian and international shares, the returns from share markets were generally very, very solid over that decade. In other words, over the decade, you were actually rewarded for taking risk. And that tends to be the way the system works. If you could sum up the way a free market economy works in one sentence, it's that you get rewarded for taking risk. And if you invest in businesses, that's ultimately where returns are generated. So equity markets did very well over the decade. The other story from this chart is perhaps to the far right, or at least the more conservative asset classes. And it's something Josh also mentioned, that the rewards that you got for investing in things like cash and term deposits and government bonds were very, very ordinary indeed, especially in the last 5 years. So the last decade, on average, you actually got penalised for being defensive. And by that I mean that the returns you got from those very defensive asset classes were actually below the rate of inflation. On average, over the last decade, inflation has been about 2.7% in Australia. Obviously, more recently, it's been much higher than that. But on average, over the decade, the real returns from these very defensive assets has actually been negative. Again, it's a theme I'm going to return to. The other story I wanted to share with you was, how do these market returns translate into the performance of the major diversified options that we manage on behalf of members? And what I've done on this chart is I've gone all the way back to 2002, basically as far back as I could get the data. So I'm not trying to gild a lily by fudging the numbers here. And I'm just going to look at what would have happened if I put $10,000 into each of these diversified options, and I just left it there. I didn't add any more money. I didn't take any more money out. I just put $10,000 into each of these options at the end of December 2002. Now, over the subsequent 20 plus years, what this chart shows is that over time, I got rewarded for risk. The performance of the high growth options. So this is the highest exposure to risk of our suite of diversified options. The $10,000 I invested in 2002, by the end of December 24, it had grown to just shy of $60,000. Now, it was a bit of a wild ride along the way. There was certainly plenty of setbacks. There was certainly plenty of periods of volatility, most notably a pandemic. But ultimately, if I was prepared to ride out that volatility, if I was prepared to accept that volatility is part and parcel of being a long-term investor, then I was actually very well rewarded for it. Now, not everybody can or should be prepared to take that level of risk. So as you go down the risk spectrum, as your investments become more and more conservative, the long-term return tends to be lower. So if you go down to the second last chart there, the conservative option, which has a significant allocation to cash and to bonds and a lower allocation to shares, my $10,000 was just shy of about $34,000. So still a credible return, but nowhere near as attractive as it would have been if I was prepared to take higher levels of risk. Now, the other line on this chart is the CPI. If, as an investor, all I wanted to do was to just keep up with inflation, then I needed to turn my $10,000 into just shy of $18,000 to keep up with inflation over that period. And frankly, we need to do better than that. So when you actually look at our paperwork, if you go online and look at our product disclosure statements, there's always a line in there about the real return objective. As an investment team, there's about 140 of us split between Sydney and Brisbane. We have two prime jobs. One is to deliver what's on the tin. If we tell our members that we're aiming to deliver a certain real return, in other words, returns after inflation, after tax, we need to and after fees, we need to deliver those returns and preferably do better than that. But we also make sure that we need to make sure we're competitive about it as well, because as Josh has said, we know you have a choice. And we need to make sure that the competitive returns that we generate for our members are very, very healthy as well. What I'm going to do in the next chart is try and illustrate this in a bit more detail. So again, these are the major diversified options that we offer our members. And what I want you to imagine is, if about 10 years ago, I picked up the PDS and then I did something really remarkable as well. I read it and I looked at the real return objective. What was the real return objective that I was aiming to achieve? And if I add on the inflation rate that actually occurred over the subsequent 10 years, what is the return I needed to deliver in order to achieve my objective? And that's the light blue columns on this chart. The dark blue is what was actually achieved. So what it shows you is that for all of these diversified options, the returns that have actually been achieved over the last decade are in line with, or mostly better, in some cases much better, than the returns that we put into the product disclosure statements and put on the website. That tells us two things. Firstly, we're clearly kind of rubbish at forecasting long-term returns in advance, but more importantly, it tells you that over that decade, the markets were kind. It was a very good time to be an investor because the real returns after fees, after tax, and after inflation were very, very robust. And inflation is really important. We always focus on building portfolios that achieve the real returns, the after inflation returns that our members need. I want you to do a bit of a mental exercise for me, people on the call. I want you to think back over the course of your life and ask yourself, how old was I when I first became aware of money, or when I first became economically aware, for want of a better description? It may have been when you've got your first paycheck from McDonald's or Coles or Woolworths or somewhere. Or it might have been when the tooth fairy first came to visit and stuck a couple of dollars under your pillow. But when did you first become aware of the price of stuff? If that was any time since March 1993, then frankly, when it comes to inflation, this has been your first rodeo. This has been the first period where you've actually had to tolerate and had to adapt to a broad-based acceleration in the price of stuff, a whole range of things. Because generally speaking, we've had 30 years in Australia leading up to the COVID pandemic where inflation was broadly in line with where the Reserve Bank wanted it to be. On average, inflation was 2 point something. In other words, in line with the Reserve Bank's policy objectives. And this chart shows you inflation going back to 1970. So for so many people, the cost of living pressures we've experienced in recent years, the higher inflation rates we've experienced, have been a very, very sharp shock to their views of the economy, but also views of their own financial well-being. Now, pleasingly, inflation has continued to decline, and that's great. But as investors, we need to ensure that we're prepared for whatever inflation is going to throw at us over the next 5 or 10 years, because it's the real returns that matter. By the way, when I do that little intellectual exercise, I tend to go back a little bit further. In fact, my first experience of inflation was back in 1974, when, for the record, I was in grade 2 on the Gold Coast at St Vincent's Primary School, and back in 1974, the price of a caramel paddle pop at the tuck shop went from 5 cents to 20 cents within 6 months. That was a massive shock to a 7-year-old growing up on the Gold Coast. So inflation is absolutely crucial. Now, Josh has touched on this as well, but as an investment team, we absolutely pay attention to what's happening in markets in the short term, but we don't really base investment decisions on our ability or anybody else's ability to try and forecast how the world is going to evolve in the short term, because no one knows that with any certainty at all, especially in the kind of uncertain environment we're in. What we do, however, aim to do is to think about how the world might evolve over the next decade and beyond, because that ultimately is going to determine what sort of long-term returns members are going to experience. And this is the sort of longer-term trends that we're grappling with. And certainly we're seeing a lot of this play out in the world as we speak. We are in a less globalized world. We're in a more volatile world. We're in a world where geopolitical disruptions, where trade disruptions clearly, but also climate-related disruptions are going to become more frequent and arguably more severe. This is going to be a much more uncertain environment than the environment perhaps that we were used to. This is also an environment where you're going to experience perhaps higher levels of government spending, especially on things like defence, and potentially also higher budget deficits. This is a world where we're likely to see higher rates of inflation on average than we experienced for the decade or so leading up to COVID. Doesn't mean we're going back to 1970s style inflation. We're not going back to the time when a chocolate paddle pop can quadruple in price in less than a year. But we do need to get used to the idea that inflation rates may be at or above where central banks want them to be for more extended periods of time. That is a significant change from the environment we had leading up to COVID. Now, one of the reasons why we don't think we're going back to the 1970s is because while there's a range of factors which are going to drive inflation up, there's also some very, very powerful forces that are going to drive inflation down, particularly the rise of artificial intelligence and technological progress more broadly. These are very, very powerful deflationary forces, and no one has a good handle on how these are going to play out over time. This is what I call the rise and then stalling of globalization. Now, globalization as a concept, the sort of interconnected world, the interconnected global economy that grew up over the past few decades, has resulted in a period where world trade grew at a faster rate than the global economy. And this is what this chart shows you. So going back to the 1960s, we had about 40 odd years where world trade growth outstripped growth in the global economy. That stalled in 2005. And given the kind of disruption we're seeing in world trade right now, and with tariff policy from the US and elsewhere, are we likely to see further disruption, or are we likely to see further maybe an unwinding of some of these trade connections that have occurred over the past 40 years? We think that's a real risk. It's also a factor which is probably going to help drive the cost of a range of goods in particular somewhat higher over time. But what it also means is that if inflation is going to be potentially higher for longer, for a more extended periods of time, before eventually settling back to more normal levels, it means it's even more important that we construct portfolios that deliver and preferably exceed those real return objectives that we tell members we're aiming to hit. And as a $300 billion plus superannuation fund, we need to make sure that we have the broadest range of investment opportunities we can find, both here in Australia and globally. And that includes not just investing in shares and bonds and cash, both here in Australia and globally, but also a range of private or unlisted assets. These are assets such as private equity. So these are small and medium businesses that are not listed on the stock market. We're also investing in infrastructure assets, both here in Australia and globally, ports, airports and the like, but also direct real estate assets. Because over time, by investing in these unlisted assets, we get two very, very important effects. One is very, very strong diversification. They help smooth the ride for members, especially during periods of market volatility, such as the volatility we've seen in the last month or so. But we also get a return premium. This is what this chart shows you. It's the value of $1,000, or value of $100 invested in these asset classes back in 2004. How has my $100 gone? And also the dotted line on this chart shows you the performance of shares over that time. Share markets have done well, but a broad portfolio of unlisted assets has done at least as well, if not better, over that time. In fact, in most cases, better over that time. Reason is because these assets are unlisted, I want a premium for the fact that I can't get on the phone and sell our stake in Brisbane Airport tomorrow. And that premium gives us a longer-term return, a better longer-term return outcome. Let me share with you some of the assets that we own on your behalf. London Heathrow, it's an iconic infrastructure asset. ART owns around 10% of it. We have a seat on the Heathrow board. We have 3 of our people based in London actively monitoring and managing our exposure to Heathrow Airport. Airport assets over time should deliver us returns between the range of, say, 8 to 12%. Obviously, these assets were very, very heavily challenged during COVID, but frankly, airport assets have now more than fully recovered. Passenger numbers are back above where they were in 2019. This is a very, very iconic asset, quite clearly. But closer to home, we also like investing in assets that by their very nature are capable of delivering returns that are almost entirely independent or largely independent, not just of the performance of financial markets, but also independent of the performance even of the economy. And one example of this, and again, very, very close to home, is aged care. At ART, we have either under construction or in operation about 13 aged care facilities across the country. And this one is a facility at Robina on the Gold Coast, which ironically is also located very close to the Robina Town Centre, which is an asset we also own a stake in. So there's a nice synergy there, because this is where the residents can go and do their shopping as well. These are very high quality facilities. We are not running the facility, we are the landlord. We provide the real estate and collect rent off the operators and the tenants. Now, regardless of what happens in the stock market tomorrow or next week or next month, the residents of these aged care facilities are going to pay their rent. That gives us a reliable stream of income and a reliable stream of returns that we can pass through to our members, regardless of what happens in the stock market. Now, I also wanted to go back to the initial chart I showed you. This is the last 10 years. This is what was actually delivered. But for us, this is kind of the rear view mirror. Investing is kind of like driving a car. The rear view mirror is handy, but the windscreen is far more important. Let's have a look through the windscreen. Over the next decade, what sort of investment returns do we think are achievable and sustainable over time for these asset classes we invest in? And we revise these returns every year, by the way. We're currently going through an exercise as we speak where we're revisiting our strategic asset allocation, how we build diversified portfolios. It's part of an annual exercise that we do. And as part of that exercise, we need to come up with a fresh assessment of what sort of returns are achievable over time. This is the latest numbers that we've been using. And the sort of pinky red line, I think it's called coral, if I remember. I think our marketing people would call that coral, believe it or not. A few observations I want to highlight from this chart. Firstly, over the next decade, do we expect to be rewarded for risk? In other words, if I'm prepared to put up with the volatility of equity markets, will I be compensated for that with a higher long-term return? Answer is yes. Will it be as strong as the returns we've seen in the past decade? We think the answer to that is no. Secondly, will I still get a premium by investing significant parts of the portfolio in private or unlisted assets? Will I get rewarded for the fact that I don't have ready liquidity? I can't sell these assets in a minute or two. Answer, we think, is absolutely yes. And the final thing I want to highlight is towards the right. The silver lining to the cloud of the last 5 years or so for more conservative investors is because interest rates have risen, because the price of bonds, both here in Australia and globally, has fallen. It means the yield on offer is higher, which means the future return I'm going to get from these very traditional defensive assets is now going to be better than it would have been if I was investing in them 5 to 7 years ago. And what it also shows you is that over time, we now expect that these more defensive portfolios will actually deliver a positive real return. Whereas 5 to 7 years ago, I couldn't have said that because the yields on offer, the interest rates on offer was so pathetically low. Let me just sum up some enduring messages about superannuation before I hand back to Josh. Firstly, I just want to reiterate again, superannuation is the longest term investment any of us are really ever going to have. And before someone online says, yes, but what about my house? My response is you can't eat the walls. Your house is basically, it provides you a service, it provides you shelter. We shouldn't really treat the house we live in as an investment. Superannuation is an investment. The house we live in provides us a service, i.e. shelter. Super is a long-term investment. And if you think about that, if you think about super in that way, it changes your perspective about short-term market events. Because one thing we also know is that when you look at financial markets and when you look at the world economy, crises are inevitable. Recessions are inevitable. Market downturns, stock market crashes are inevitable. They are part and parcel of any long-term investment journey over the course of somebody's working life. So if I was 21, 22 again today, or if only, and I was looking ahead at 40 or 50 years of working life, how many recessions would I expect to experience? 4 or 5 maybe, 6 or 7, I don't know. How many major stock market corrections would I expect to experience? Maybe 10 to 15, maybe more. How many pandemics? Hopefully only the one, because no one wants to go through that again. But we know they are part and parcel of anyone's long-term investment experience. They are absolutely inevitable. They're almost impossible to predict in advance in any reliable way. We cannot design portfolios based on our ability or anybody's ability to forecast the very short term. What we can do, though, is take advantage of volatility. So if we see a period where share markets fall sharply, such as we saw after President Trump's Liberation Day, Does that provide us with opportunity? Yes, it does. We expect our managers and our internal investment team to take advantage of that volatility. That's exactly what they did in the days and weeks following President Trump's announcements. We can't also predict how the world is going to evolve geopolitically. We can't design investment strategy that way. What we do know, though, is that when we think about these crisis events, they all have one thing in common. They come to an end. Every crisis, every bear market, every downturn, every recession comes to an end, bar none. There is a light at the end of the tunnel, and it's not a train. It is the end of the tunnel. And with that, I'll hand you back to Josh Van Gestel.
Thank you very much, Brian. And I think I've heard that paddle pop story.
I changed the flavour because I know you're sick of it.
Well, the caramel was actually my favourite, so I'll take that. But for me, the first experience for me was actually the price of Lego soaring, which I was only a few years behind you. But as a kid, all my pocket money went into Lego, I think. Okay, so now it's really important. We've seen a lot of questions coming through, some of which actually I'm going to address in the next couple of slides. But in about 10 minutes' time, we'll come to Q&A to start responding to those. I encourage you, if you do have any questions for Brian, please do make sure that you're putting those into the chat and our moderators will reflect on them. What Brian's been talking about is the volatility that we've been seeing in markets in the last few months in particular. And during that period, we've all been riding not just a wave with our investments, but also a wave with our emotions. And I think about it that I've been looking at my balance more than I normally would. My wife has, who is also an ARP member. My twin brother, who is also an ARP member, and it's his birthday tomorrow. Happy birthday, Dom. He's also been looking at his balance and talking to me. Even the studio crew here, we were talking to before we went live. And the thing that we've got to be aware of, and Brian spoke to this, is that we're seeing that it is in times like this where we tend to make decisions based on how we're feeling. But there are opportunities and there are also consequences around some of the decisions that we make. And I just wanted to reflect a little bit on history when we have seen such market volatility in the last 15 years or so that give us a really good reflection for what we're seeing people do now and the impact that that could have over time. Brian talked about COVID, and what I'm showing here is what happened to the performance of some of our diversified investments during the period of COVID. Now, one thing I just wanted to clarify with the figures that you're seeing here. I've got a starting balance of $300,000. I'm assuming for this exercise that is actually a person starting a retirement income stream, and they're not just going through the experience of investing, but they are also withdrawing 5% of their account balance as pension income from their super each year. Okay, so we're also seeing the impact here of not just investment markets, but also withdrawing money from their super as a pension. What we saw in the period of COVID was that, as I said, some of our diversified options did suffer with market volatility. And so people made the decision to seek comfort by moving to cash. And that would have potentially given them short-term comfort. And as we're showing in this illustration, a person who may have done that may have actually come out better off in that short term. But what if we played that out? Instead of looking at 1 year, let's extend it out to 5. And the reason that this is important to consider is that quite often we see that people who may move to cash or a more conservative option then don't know when to come back in. They're concerned about when they should come back into some of those investments, such as shares, for example. The other thing to note, though, is that when you move from an option to something like cash, you are basically locking in your losses. You are not going to get the recovery that Brian was talking about. So in this same example, I'm showing that person starting with $300,000 as a retirement income account, so withdrawing 5% a year again. But we're seeing that that move to cash, now over a 5-year period, has significantly changed their retirement position today. If they stayed in one of those diversified options, and we understand that emotionally that may have been difficult for some, but if they stayed in one of those options, even though they've been withdrawing 5% a year, they would have actually been around or much better off than their starting position than if they moved to cash. But if we wanted to be really dramatic, and I have met members in the last few weeks and months who absolutely could relate to this, and this does actually reflect what we've seen some do. If we took that person just before the global financial crisis and assumed that they made the decision in the depths of that crisis to move to cash, the impact to them 15 years later would be enormous. If they had stayed in those diversified options that Brian has been talking about, thinking they're not just invested in shares, they're invested in a whole range of assets, then we'd see that that member would today be significantly better off, even though they've been withdrawing income, than they were at the starting point. If though they were in cash, especially considering that Brian was saying those returns have not been strong in recent years, they would have actually locked in those losses, crystallised them, and now been eating into their balance to take those income payments. So the impact of moving to cash, although it can provide emotional comfort, should not be something that you do on impulse. It should be something that you consider. And again, we've had a number of questions come through on this, so we may, if time allows, come to those in the chat, in the Q&A. Now, a couple of things to then think about. Well, where do I go from here? I encourage all of you to access our website, which has access to incredible education, including videos, webcasts, even social media that we've been doing through podcasts and other things, gives you a wealth of information, including performance. And if you look at those performance numbers, although you'll see that over the last 3 months or over the last 6 months, there may be lower performance than you'd want, if you looked at that over the last financial year to date, or the last year, or even looking over the last 10 years, you'd see that the performance is still strong to give you comfort over the long term. You also have the ability, though, to check in on your investor profile, to think about whether you're invested appropriately or whether you should actually make a change to the way you are invested. So we encourage you to jump onto the website, explore and take comfort, and also think about your own investment profile, which might just give you the reassurance that you are invested the right way. You also, though, as both Brian and I have mentioned, have the ability to make choice with your investments. At Australian Retirement Trust, we offer you 16 investment options that give you incredible choice around what we do with your money and how we look after that for you and invest it on your behalf. Again, visit our website and seek out further information in regard to that. So the next steps from here, I encourage you, particularly those of you who are approaching retirement, perhaps already in retirement, just think about the impact that these times may have had in your retirement. Have they changed your expectations? Have they changed your goals? Do you maybe need to check in on what you thought you may have? Do you still have time available to take advantage of the opportunities and the long-term nature of super that Brian has outlined? Consider too your investment options, and also, if able, think about how you may in these times take opportunity, such as adding contributions to your account, which I'll actually get Brian to speak to in one moment. But fourthly, if by going through this exercise yourself of looking at our information, of looking at our webinars and podcasts and other assets that are available to you to help inform you, if you still need further comfort or direction, speak to us, or if you've got your own financial advisor, I encourage you to reach out to them. You have them on your side for a reason. Now, with saying all of that, Brian, there has been a lot coming through on Q&A, but I might get you to start on where I just mentioned around some people, which we've had coming to us at the seminars we've been doing around the country, actually saying that they were thinking about contributing. Can you give an idea as to why you think that is an opportunity, but also how that reflects on what we're doing as investment managers as well in that regard?
Yeah, it's a good question. I think it does reflect very much what we have been doing internally. When we see periods of market volatility, our first instinct is to look for opportunity. And that's exactly what we've been doing. That is what professional investors fundamentally get paid to do, to take advantage of periods of crisis, take advantage of market volatility. And that's certainly what we've been doing. It's hard to do. I think, especially during times of emotional stress, the ability to step back and just think dispassionately about what's been happening and being prepared to acknowledge that I am a long-term investor and at some point markets recover and I want to be well positioned for that recovery. That's ultimately what we get paid to do. And if you're able to make that decision, if you have the resources and if you have the understanding and you have the patience on your side, then certainly periods of market volatility, while very, very unsettling, also provide opportunity. So,
thank you. A number of questions, obviously, around the US based on what we've seen. Will we decrease exposure to the USA? And we've actually had a number of people ask around this.
That's a really, really good question. And I think one of the things I'd say is that, again, as investors, we need to check politics at the door. Our job is to base investment decisions on professional analysis and research and a fundamental understanding of the investment opportunity. And I think when you look at the United States, you need to be able to distinguish between the US as a political system, which is clearly, shall we say, challenging, but also the US as an investment destination. The US economy is still the largest, most dynamic and innovative economy on the planet. And so we inevitably are going to have significant investments in the United States. And those investments still make absolute sense and are still likely to deliver good returns, shall we say, despite what is happening in Washington, D.C. Let me give you just one example, especially in the private asset space. We actually have some renewable energy exposure in the United States. And you might ask, well, why would you do that, especially given the attitude of President Trump to both climate change, but also to things like windmills, which are fairly well documented. And firstly, a lot of the investments we make in that private asset space, the legislation and regulation and policy that surrounds them actually happen at the state and local level. What happens in Washington, D.C. has little to no impact on them. And secondly, what we've also found is that when it comes to things like renewable energy assets, even in the reddest of red states, they like the investment and they like the jobs that these investments bring. So I'm not saying we ignore what is happening politically, but we basically make sure that when we're thinking about what's happening politically in the United States, it's about, well, how does this affect our investments? If it doesn't affect our investments, then that's great. We go in with our eyes absolutely wide open, but remember, the United States is still the biggest economy in the world. It's still a very, very dynamic place to invest. Its businesses are still some of the best at what they do in the world. And so should we not be investing in the United States? I think the answer to that is no. We need to keep investing in the United States.
If I can extend some of that, Brian, Vivian's actually asked, ART has increased its exposure to private credit and alternatives. Is this done internally? And what sort of investments do we make ourselves?
That's a really good question too. We invest either with or alongside a range of external investment managers. If I think about it, we do invest in pooled funds that some of these managers offer, but increasingly we're conducting what we call co-investments, where we invest in our own name alongside managers that we have a very, very high regard for. We have an internal investment team that spends a lot of time doing due diligence on particular transactions in things like infrastructure and real estate and private equity and private credit, both here in Australia and internationally. But we're very much choosing to partner with high caliber investment managers to both provide us access to these investment opportunities and help us with the investment decision making, but certainly we built up a lot of expertise internally, which allows us to take a more active interest in how these assets are managed. And London Heathrow is a prime example. We were paying a manager to look after our interests in London Heathrow, but we've come to realise that we had the internal expertise to do that. We put 3 of our own people in London to oversee our exposure there. We rent office space over there, and we terminated the manager. And net, we've managed to save our members by doing that.
So can I ask, with some of those partnerships, are those things that we've got a reputation in? Do we go hunting for them, or do they come to us? How? Because they're big investments.
It's a bit of both. Certainly, our team spends a lot of time on the road, talking to our partners and doing on-site due diligence with particular investments that we make. But also, when you are one of the top 25 pension funds in the world, there's a lot more people knocking on your door than there used to be, perhaps. And so it's a bit of both. We go hunting, and people also come and seek us out. What we also find is that because we have the kind of experience in investing in these assets, and because we have scale and because we have capital that we need to put to work, if an investment opportunity comes up internationally, we are going to be one of the first calls that get made. And so having that access, having seats at more tables, I think really delivers real benefits for members in terms of the investment universe we get access to.
Fabulous. And just for full disclosure, I'm not tweeting or texting on my phone. I'm actually looking at, we do have a lot of questions coming through. Something much closer to home, actually under our feet perhaps. Do we invest in commodities, and why do we not have an investment option that actually has a strong exposure to commodities?
Yeah, I get the question a lot. We certainly, as part of our diversified strategy, we do have a small commodities program where we invest in a basket of commodity futures. Provides us a bit of marginal diversification, but it's not big. It's a very, very small part of the portfolio. We do, however, of course, invest in companies that benefit from rising commodity prices, for example. So do we invest in Australian miners? Do we invest in resource companies globally? Absolutely we do. And so we find that that gives us trying to forecast how commodity markets are going to go in the short term is a massive challenge, almost impossible. But investing in businesses that actually mine and distribute these commodities and make a profit and pay dividends by doing so, we think that's probably a smarter way of doing it. So that's kind of how we do it. The other thing is, why not offer a commodities option? We deliberately keep our investment menu tight. So we want to make sure we've got enough investment options so that the vast majority of members can build portfolios, preferably with the aid of financial advice, build portfolios that make sense for their particular needs, but not so much choice that we end up with small pools of money in a whole range of different options. We need to make sure that if we offer an investment option, that the member demand is going to be there to justify the cost of launching that option, because it costs members money. It costs money to actually build an investment option and to offer it. And so we need to be confident that the demand is there. And frankly, you'd never say never, but at this stage, the realistic member demand for a purely commodities option, in our mind, doesn't justify the cost. Because at the end of the day, we are spending members' money by offering this.
Would it be fair to say that often that question around commodities option only comes up at times like this?
Yes, it's funny how after the gold price goes on a bit of a run, you do get the odd question about, can I invest in gold? And again, it comes back to my point about windscreens and rearview mirrors. The gold in the rearview mirror looks wonderful. Gold through the windscreen maybe doesn't. I don't know. So it really does come down to I think we need to make sure that members are able to build sensible, well-diversified portfolios, either that suits their own needs or that we build a diversified portfolio using the broadest range of investment opportunities we can find. That's kind of how we think about it.
Couple of questions come through. I hope I'm not going to trigger you with this one. But thinking about mining, but mining in a digital modern sense.
Oh, you had to bring that up.
I have to bring up Bitcoin and why don't we? Or how do we think about it?
Firstly, some of the underlying technology behind these cryptocurrencies. Do we have some managers who are interested in the underlying technology and how it might be exploited? Yes, absolutely. But the coins themselves, these are highly, highly, highly speculative assets. They're extremely volatile. It's almost impossible to forecast where they're going from one day to the next. They pay no interest or dividends. They're traded on exchanges that are often somewhat opaque. Is there scope to invest in digital currencies that may be offered by the major central banks of the world? Yes, that's potentially interesting. But frankly, we would much rather invest members' money in assets that basically grow with the economy, that pay interest, that pay dividends, that pay rent, that we can collect that income and reinvest it for future growth. So at the end of the day, how is wealth generated in the economy? Wealth is primarily generated by businesses. Yep. Businesses that offer, that provide us with a whole range of goods and services, make a profit by doing so, and they pay dividends and they reinvest in their business for future growth. That is a more reliable way of building longer term wealth than frankly having a punt on Bitcoin.
So a question that has come up, and I haven't been able to check some of these numbers, but I think the theme is still right. We've had a question on the tariff volatility and just thinking around how super funds react to markets and things. Why have super funds not recovered all the losses that we had due to the recent Trump announcements? I am still down after we've actually seen some markets recover. So,
yeah, and again, it depends on where you are invested, but certainly markets remain volatile. We have no way of knowing when markets fully recover or how fast they fully recover, but history tells us very strongly that they do. And secondly, again, goes back to my point about superannuation being a long-term investment, and periods of negative returns are inevitable. They are part and parcel of a long-term investment journey. It does beg the question, why would I put up with the stress of these short-term periods of volatility? If I am prepared to put up with these short-term setbacks, the reward I get is a better longer-term outcome.
Yep.
And I think that's, if there's one clear message to take out of today's call, is that longer-term nature of superannuation. The periods of negative returns are inevitable. They're impossible. The short-term recovery is almost impossible to forecast. Do they provide opportunities? Yes, they do, and we've taken advantage of that. Am I confident that anyone investing a significant part of their wealth in equity markets today will eventually recoup that and go higher? Yes, I am, but the timing of it is almost impossible.
Just thinking about timing, a question came through just to really clarify something that we both touched on, which was, what did we mean by talking about taking advantage of volatility, like in regard to the recent Liberation Day event?
Yeah, so for example, what we saw on Liberation Day and subsequently, we saw share prices around the world fall very sharply.
Yep.
And what we find is that, as share prices fall, that's an opportunity. If we get an opportunity to buy a basket of quality assets at a lower price, that's what we do. Do we have the capability to actually do that? Yes, we do. We're not trying to, shall I say, to use a cricket analogy, we're not trying to hit every ball for six, but what we're trying to do is take advantage of this short-term volatility to add a bit of incremental return to our members' balances over time. And so when you see share markets fall in the short term, we had the capability to enter into markets and take advantage of that very, very quickly, which is what we did. So we bought equities globally in the period after Liberation Day.
Yep.
We had no idea, we certainly didn't expect share markets to bounce as rapidly as they did, but when Trump initially walked back some of the tariff measures, or seemed to walk back some of those measures, we were very well positioned for that massive recovery we saw in share markets. So that's what we mean.
I think it's amazing, even if I looked at my own balance over the last month or so, There were periods where in 2 days I saw my balance go down $10,000. In the next week I'd see it go up 13. I'd then see it go down again. We were really talking about upheaval, weren't we?
Yeah, we were. We certainly saw some of the biggest share market moves, short-term share market moves that we typically ever see. And as I said, this is disconcerting.
Yeah.
I often say to members, and I think you being the education manager, looking at your balance every minute of the day, the plumber has leaky taps, people. But I'd often encourage people not to look.
Yep.
Because the more you look at every wiggle in markets and how it's impacting your balance, I think it's both emotionally draining, but also it's not helpful. I think we need to take a step back and, as I said, focus on superannuation as a longer term investment. Focus on, well, what is my realistic time horizon? What phase of life am I at? What is my appetite for risk? Am I sleeping at night?
Yep.
And the ideal to me is if I'm in this kind of market environment and I accept that this is part and parcel of being a long-term investor, and if my asset allocation, if my investment strategy suits my phase of life, and in particular suits my risk appetite, such that I am sleeping soundly at night, then there's nothing I really need to do at all in response to this. And frankly, the sleep at night test I think is a really powerful tool. If you're doing something with money, it might be your super, it might be your mortgage, it might be a personal loan, whatever. But if you're doing something with money which is causing you to lose more than about a minute of sleep at night, it's almost like your body telling you something. Your body is telling you you're taking too much risk. And I think that sleep at night test is a powerful tool.
I want to come back to that, but before I do, we've still got a lot of questions coming through. I'm actually going to extend this out for another 10 minutes, if that's okay. But if I can talk about that sleep at night test and maybe thinking about us taking advantage of opportunities, not to say our investment team are robots, but do you think, I showed earlier about the emotional cycle of investing, do you think partly we can take those opportunities on behalf of members because we are somewhat emotionally, we're doing this as a profession, that members then have this emotional view that they've got to consider? Would that be?
I think that's possibly, it is, this is part and parcel of what professional investors do. Yep. I should also point out that I suspect that most, if not all, the ART investment team are ART members. Yep. We strongly believe in eating our own cooking. So full disclosure, the lion's share of my super is in the default. And I think that's important because the default option that we run for our members is basically doing what I would be doing if I was not doing my day job and actually managing my own super.
So can you just on the default, how in times like this, the default option was largely created in some regard for times like this. How's the default work?
Yeah, the default works by up until the age of 50 years old now. So if I was up to the age of 50, the default would invest me in the high growth pool. So I would have about 85% or so of my portfolio in higher risk assets such as shares and private equity and the like. Okay. When I turn 50, happy birthday from ART, the system whirs into action and starts to very, very gradually reduce my exposure to risk. And it does that in monthly steps, starting from my 50th birthday. So by the time I am 65, 20% of my portfolio will be in cash. The 80% of the portfolio will be in the balanced pool. What that equates to, I think, is that by the time I'm 65, the default will have me about 56% or so exposed to these growth assets. And for me, that's a nice compromise because it means that I've still got exposure to growth assets because I hope to live a hell of a lot longer than 65, but I'm also not so exposed that I'm losing sleep at night. So that's what the default aims to do.
I'm going to come back to some of that. But firstly, as the education manager, the reason I check my app every week is firstly because I think the app is great, but secondly, I am a case study. So I should careful how you unpack that, Brian. Yeah. Okay, so super is a long-term investment, also throughout retirement. Why is it often promoted to transfer our funds into a more conservative option when retiring? Could we not leave it in a higher growth fund option to get better returns for the next 30 years?
Look, that's a really good question. And again, it is horses for courses. Everybody's different. Everybody has different appetites for risk. Everyone has different financial goals and financial needs. And so if I get to my mid-60s, for example, and I'm comfortable with the risk and I've got and I want to actually take a bit more risk, as long as I'm going into that with my eyes wide open and I understand that this does come with more volatility, well, maybe I would be happy taking a higher level of risk, but that's not for everybody. I think it comes back to that sleep at night test. Yep. So I would say to the questioner, if you are comfortable with that risk and you're comfortable that any short-term fall in share markets is not going to blow your investment strategy out of the water and it's not going to ruin the rest of your retirement, then there's no automatic reason why you should become more conservative. For a lot of people, it may be quite natural to become more conservative as you retire. But I would caution against becoming too conservative for the reasons we've talked about. We all hope to live a long time. We want our money to last. But again, the answer to what sort of investment strategy I should have in retirement, the answer is it depends. It will vary with each individual member.
It's interesting because conversely, we've actually had the questions about, I'm in my 70s, should I still be taking a long-term look? Should I now be moving all my assets into high growth to take advantage of the upturn? At the end of the day, it comes back to that sleep at night test.
It does, totally. And again, even if I'm in my 70s, if I'm in my 70s, I would ideally hope to live another 20 years because I want to annoy the hell out of my kids for as long as possible.
And I
so
know
that
your
would
kids,
mean,
I don't know that they'd enjoy any of that.
Oh, I'm sure they would. They really would. Especially if I had a decent balance that I could pass on to them. I'm sure they'd be very happy with that.
I think
but
at
even if I
least
was
one
in
of
my
your
70s,
kids is online today,
I think she is, absolutely. But basically, even if I'm in my 70s, it means that I would still have a time horizon of 10 to 20 years potentially, if I'm lucky. And so even in my 70s, I don't really want to be hiding money under the bed. I'm still probably going to be wanting to take a little bit more risk. But does that mean going into high growth? Again, it depends on each individual member.
Let me take a step out a bit. We've got two questions. We've got 4 minutes left. So let's see how we go. They're two big questions. The first one is, how is China affecting our investments, either now or how we're looking into the future? And which has more impact on our investments, the US or China?
That's an excellent question. Firstly, when it comes to China, we actually have I don't think we have any private asset exposure in China. It is a challenging place to invest from that perspective. We do own some Chinese equities and bonds, but generally speaking, the direct investment exposure we have to China is somewhat more limited. But make no mistake, if you are living in Australia and you are investing in Australian shares, if you are living your life in the Australian economy, whether you like it or not, you are exposed to China. China is our largest export destination. We have done very, very well as an economy by putting a large number of eggs into a very big basket labelled China in the past 20 years, courtesy of the boom in demand for iron ore and a range of commodities. So China, we are inevitably exposed to China risk whether we like it or not, by the virtue of being Australian. The direct exposure to the United States in an economic sense is actually relatively limited, but we have a much larger investment exposure as a fund. In fact, most superannuation funds in Australia, I think you'd find, have very significant US investments. As I said, it's still the biggest, most dynamic economy in the world. Its businesses are world leaders. There's enormous investment opportunity across a range of asset classes there, and we think those opportunities continue. Developments in China, if, for example, the trade war results in a major downturn in the Chinese economy, that certainly has implications for Australia's exports and for Australia's export performance. However, if that were to occur, you'd almost certainly see the Chinese government step in with massive support for their economy. That in turn would benefit Australia's economy. So it may be that any negative impact from China on the Australian economy may prove to be short-lived because the Chinese authorities would stimulate. And that would benefit demand for Australia's exports. We'd also likely to see a fall in the Australian dollar if that were to occur, and a falling Australian dollar does help cushion the blow for Australia's exporters and for Australia's economy if you see a major shock. The last time, that certainly happened, for example, during the global financial crisis. It happened in the Asian financial crisis in the late 90s, for those of us who remember that. What you want a floating currency to do during a crisis, you want the currency to sink, frankly, because that provides you with a cushion. It provides you with protection for your economy. I think that's probably as brief an answer as I can give, given the time.
And I think, although we're talking about China and the US now, I've still got 40 years hopefully ahead of me with my investments in super. I even think about where India will be or other economies.
Absolutely, and India is still several decades behind China in its development cycle, and there's likely to be significant investment opportunity in India over the longer term, but it's a much slower burn because India is, we're talking about a very messy, very diverse democracy. It's kind of inefficient and bureaucratic. It's a multi-state federation. But is there investment opportunity there? Absolutely. Do we have money invested there? Absolutely. We have some private equity investments there that we've benefited from very greatly in the last little while. So India is an exciting long-term story, but it's a long-term story. And also, don't forget, just because it's a good story doesn't necessarily make it a great investment. It's all about, can I buy that story at a fair price and get a fair return out of it?
Last question, Brian, because then we do need to get you to the airport. If we are in a downturn, should we now be thinking about, it's just moved for me. Do we believe unlisted assets is a good investment option for 2025, and why? And I'd say the proof is in the pudding a little bit about
Absolutely.
what we're doing.
Look, the unlisted assets, I'm not saying they are not immune to what's happening in the economy. And if we were to see a major economic downturn, would that affect the value and the performance of our unlisted assets? Yes, it would. But when you look at the history of the way these assets perform, when share markets are running hot, they tend to lag a bit. They don't tend to go up in price as much. But the flip side of that is when share markets go through a really, really tough period, these assets tend to hold their value to a much greater extent. So we don't trade in and out of these assets. By their very nature, they are illiquid assets, but they provide very strong long-term returns. They provide a very broad investment opportunity set, and they do help smooth the ride for our members during periods of market volatility. We saw that during the GFC, we saw that during COVID, and we've certainly seen it in the last couple of months.
Brian, thank you very much for your time. Thank you also. I know that over the last few months, you and our education team, including myself, have been running around the country and also doing lots of webinars. We've been very busy, and a lot of that information is on our website. But thank you to all of you for your time. Thank you for all your questions, and thank you to the wonderful team who helped us at very short notice, I may add, to actually bring this event to you all. We do wish you well. We do encourage you to seek out further information and comfort on our website. And again, please do reach out to us or speak to your own financial advisor if you want additional support and assistance there. A copy of this video will be sent out shortly, and we look forward to also receiving your feedback. Thank you very much.
Thanks, everybody.
Talk to you soon.